Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul discuss the ProPublica article that explored the true tax rate of the wealthiest Americans. The article examined income taxes as a percent of growth in wealth. The findings were nothing short of remarkable. Our hosts explore the fairness of ProPublica's methodology and further uncover our income tax system's regressive nature. They go through a thought experiment to unravel the rationale behind taxing income and relate how the current system contributes to wealth inequality. While any solution will be messy, there's no fundamental reason why we can't come up with something better. Unless, of course, we simply don't have the will to do so. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So, several weeks, ProPublica came out with an article looking at the 25 wealthiest Americans or wealthiest households, also looking at the income taxes paid by those 25 and compared the income taxes paid to the wealth growth of those 25 wealthiest households and created a metric what they called the true tax rate. And this was very similar to a conversation that Trish and I have had in the past about the U.S. tax system and the kind of difference between wealthy versus income earners. And we want to do a deeper dive on this article. One, kind of, is them labeling the true tax rate a fair assessment? Taking a look at what are some, not only say alternatives, but at least having a thought exercise on, given this case and given the information we do have, what are some of our observations or potential ramifications? I don't think we're going to be going into how ProPublica got the information on their private tax returns. That's a different ethical conversation on journalism, but today we're really focusing on that, just the concept of the income tax system in the US, the wealth growth of these wealthy individuals, wealthy households, and is it fair for ProPublica to dub this the true tax rate? So, Trishul, do you mind kind of starting us off? Give a quick summary on the article, or at least their process, and what some of their initial conclusions were.
Yeah, happy to, Aaron. At a high level, it tried to provide some insight into how taxes reflect the actual growth in wealth for the top 25 richest households or Americans. And it began with just an article kind of starting off with the conversation based upon a leak of information. Again, we don't know exactly how that information got from the IRS to ProPublica, but it was an anonymous source, and then that's kind of all we know at this point. And at a high level, what ProPublica has done is they tried to take that information and put out what they thought is insightful to us in terms of stuff that might be important or maybe vital for the American citizens to know about our tax system and how it functions at the highest levels. And to do that, what they did is they focused on this notion of, okay, how much income taxes do the wealthy actually pay? And then we do also know, what happens in terms of their wealth and their growth in wealth, and that can be studied through proxy or through closer approximations based on actual holdings. And from there, they conducted actual analysis, or you might call it research, by combining these various metrics and crunching the data and coming up with statistics. And it's those statistics that'll be, part of the conversation today. Aaron, you mentioned the prime one, which is the notion of okay, how much did a very rich person pay in taxes in a given year versus how much did their wealth grow in a given year? And you track this over many years and you get an interesting picture. And then you compare that against what those numbers might look for the average household, and you get a pretty interesting understanding of how maybe things have ended up the way they are now. And as far as that, there's some insight that we highlighted over a couple of episodes in this podcast of how initially when we talked about UBI, how incomes have changed over our last generation, and we've also discussed how wealth has changed in terms of its dispersion among the population. And in both of those cases, the rich have gotten richer and the poor have gotten poorer. So I think that's why this understanding of how this may have occurred and tying that back to taxes is probably the impetus for why this is a pretty important conversation in the eyes of the ProPublica team.
So I guess on my first my first thought is just like, is this a fair assessment? But I think I want to kind of save that for the second question. I guess the first one is when we look at this kind of income taxes versus wealth paid. I think the article provides some context where at their level, the wealth growth is because it's almost like because they already have so much in wealth, their wealth growth is just a greater percentage, a significantly larger number. So I think they used the example of Warren Buffett. Wealth growth was 24 billion. Income reported was 125 million. For Jeff Bezos, wealth growth was 99 billion, but income reported was 4.2 billion. Like they're still actually reporting really, really high incomes, but it's looking at it compared Bezos' financial picture to typical American household, and the wealth growth compared to taxes paid was significantly larger, whereas the typical American household, it showed total taxes paid was about $142,000 over a 12-year period, while the wealth growth was $89,000. And it's kind of like they seem to be in line for typical American household versus the super wealthy. I'm trying. So that's my first thought. Is like, is it the fact that they already had the wealth in the first place and they just saw the growth on top of that? Is it because the stock market has done so well over the last decade? Is because they're not necessarily saving more. It's just what they already had grew, but they are paying. They're claiming really high income numbers and paying taxes on those incomes. So I guess the kind of the two questions I'm thinking of is the difference between these wealthy 25 versus typical American household. And then this next question will be, is looking at income taxes paid versus wealth growth a fair comparison? So I guess first, like when you look at these wealthy 25 versus typical American household, what was your first thought? And like why does wealth growth correlate with taxes paid for a typical American household in a way it doesn't for the wealthy?
Yeah, so that this kind of zeroes in quite finely on some of the concerns we raised, or maybe this was like last year, probably last year when we talked about, the title of the episode, this was episode 37, is How to Get Rich and Never Pay a Dollar in Taxes. And we highlighted, how does this happen? How is it possible given what we think are maybe high tax rates for high income earners? 37%, that sounds very high. But when you look at these numbers, it's possible to amass great amounts of wealth and pay nowhere close to, 37% on, the growth in wealth. And again, the growth in wealth and income are two very different things. But to put it very simply, let's say I have $1 million in wealth and it doubles over a 10-year period, 1 million to 2 million, and I don't sell anything, I don't have any dividends or other tax events to account for. My wealth has doubled, yet my taxes are zero. That's just how it works. If you have capital gains that are unrealized, then it's a very simple way to grow wealth and not pay any taxes. Our tax system says when you sell that stock, maybe you'll pay taxes then. I say maybe because there's ways to kind of get around that as well. But that was kind of the premise of what we discussed in that episode, that, yeah, it's quite possible to grow wealth and pay little in taxes. And this kind of shows how that has been accomplished quite successfully by the 25 richest individuals. And again, very simply, the big difference between a wealthy person and an individual is the way an individual needs to accumulate wealth is, well, first they got to earn an income. That's typically how it happens. And when you take home an income from a position like a W-2 earning position, the very first thing you do is pay taxes. Now, if you're a wealthy person and you own a business, well, the first thing that happens in that chain of events is the business takes in income. And the business does tons of little things like investing in itself. So at the end of the day, individuals who earn income, they pay all their taxes up front, and then they have to take care of all of their individual expenses, and then whatever's left at the end goes into the wealth pile. And with wealthy individuals, the script is flipped. What they get to do is they get to have their businesses take in revenue. Then they get to do everything possible to make that revenue grow bigger. And whatever sliver is left, that's what they pay taxes on. And for many of these wealthy individuals, what we're realizing is the strategy is to have nothing left, meaning you do everything possible to grow your business. And you keep it growing into the future, keep investing in the business's future such that nothing ever needs to get paid until the business is 10 times bigger, 100 times bigger, astronomically bigger, until it's kind of like a non-issue to take a sliver off of 100 billion and pay your $1 billion in taxes. So that, that's kind of at a high level how it seems to be working. Whereas for an individual, again, to grow, what the data says is, to grow your wealth by like $90,000, you have to pay more than $90,000 in taxes. You have to put more than yep.
So the big correlating factor there is typical American household, because they're income earners and income's taxed at higher rates, then they have to save based on that after tax dollars, sort of, because you have 401ks, but even the tax deductions of 401ks impact take-home pay and lifestyle. But because income is taxed at higher rates, that impacts the ability to save. So you're less likely. There's a kind of that's why you have that correlation between income earned, taxes paid, and wealth growth versus the wealthy, because one, wealth growth is not necessarily taxed. It's not taxed until you sell, and taxed at lower rates. The growth on their wealth is going to have a significantly lower tax amount compared to income earners. So I think that makes sense. That like the difference is the income earners versus capital growth.
Right. Like in my mind, I always thought of, myself and the income that I brought in. I thought of myself as a business. I earn money, but it's my business that takes in revenue. That's my income in air quotes. And I use that money to grow my business. I invest in myself, my education. I got to feed myself so my business can keep going and so on. And the tricky part is, because I'm, not an official business, I'm a human business, my taxes have to be paid up front, and I can't necessarily reinvest in myself and expense all of that, meaning get tax-free deductions on my education and whatever I need to grow my business, like a typical business can. And that's what kind of makes a big difference here. Whereas a business, they can do everything possible to grow their business and expense all of those and get deductions all of those, such that if they're reinvesting in their future, just like how I am, their expenses are deductible.
Okay, so that's a good point. But I think my next question, because I'm going to put together a thought exercise in a few minutes. But when we look at the ProPublica's true tax rate, do you feel that is a fair creation of theirs?
Well, I think it's a statistic, and it's one of those things like, what do you do with a statistic, and how do you use it to get some sort of benefit? On its own, it's just a number, and anybody can create numbers. It's how those numbers get used and what insights they may provide that end up making the difference at the end of the day. And whether it's important or not, I think it comes back to this notion of what we tried to highlight in our earlier conversations on income inequality, where we kind of saw this runaway effect. And the notion there was, there was a good conversation on is our tax system progressive or regressive? And we looked at it from the income standpoint, but we also highlighted the concern on the wealth standpoint. Now, on the income standpoint, the concern there was over the past 40 or so years, the data we looked at was from 1979 until, the mid 2000s, or sorry, the mid 20 teens.
Mid 20 teens
ish. So, that's a good 30 or so year period, about a generation. And we looked at the income growth over that period. And what we noticed is that for individuals in the 40 to 60 percentile, meaning, the middle of the pack, their incomes, after you adjust for inflation, inched up by around 8%. So that's not compounded. That's a total, point-to-point change around 8%, less than a sliver of a percent a year in real income growth for the median worker.
They don't just barely keep pace with inflation or something like that.
Yeah, that's pretty much it. Now, if you're below the 40th percentile, the bottom 40% of income earners, your income went down over that generation. You're doing worse in real terms. You're doing worse off. Okay. But if you start looking at the higher percentiles, if you look at the top, 1/10 of 1%, the income in that bucket increased after adjusting for inflation by almost 400%. And if you look at the 0.01% of income earners in that time frame, 35 years or so, well, those incomes increased by 600 to 700%. But here's the deal, that's nowhere near the full picture, because what we're realizing is incomes don't matter so much. It's the wealth disparity that has changed so much over this time frame, because you can gain $100 billion in wealth, and if you pay almost no income, who cares how much your income grew? You can basically amass 100 billion or so and pay a fraction of that in income. That's what ProPublica is trying to say, and that's what we need to think about. So as far as wealth disparity, well, that's a different line of reasoning, and that's how is the breakdown of wealth changed over the past 40 or 50 years? And that shows a similar regressive trend where, for example, and this data goes back to the 60s, 1965, the top 5% of Americans owned about 55% of the wealth in the country. And if you look at that going back to 2016 in this case, so this is still 5 years old, the top 5% controlled about 67%. Now you slide that forward. This has been accelerating, so it's getting worse and worse each year. But if you slide that forward, that if that 65 turns into 85, 95% over the next generation, that same differential, just move it forward another generation, it kind of might put a strain on society if 95% of the wealth is concentrated in 5% of the homes. it might make things harder to function if all of the wealth is in 1 out of every 20 people. So what's happened over that same time frame is the bottom 90%, their wealth has shrunk. They used to command about a third of the wealth. And if you look today, the bottom 90% of households only command about 20% of the wealth. And the bottom half has basically nothing.
So I agree that there is a problem. I kind of agree with the overall conclusions. But in practice, I'm a little curious where potential solutions might come. And so the reason I frame it that way is I'm going to take a few minutes to kind of describe a thought exercise that it sounds very similar to what you were saying, but I want to phrase it a little differently. And given that context, I want to hear your ideas on even potential ideas, not necessarily solutions, but just ideas moving forward. So let's say there was a very small business owner or a manager at a really small retail shop, mom and pop general store. They own a not a 7-Eleven, but like a little convenience store. They're doing well, and they save up, and so they're able to buy a slightly bigger place. Let's say they start off leasing it, but they buy a slightly bigger retail store, and they're just really good at running the business. So they have a good understanding of their inventory, of pricing, and because they're doing very well, they are attracting a lot of customers. And so let's say from a business perspective, we'll say they're successful at every turn. And so the owner of this business only takes, let's say, a $200,000 salary. Like that's kind of enough to be like consistently running a business, and it's just one of the business expenses. Kind of every chance they get, they hire more employees so that they can provide better customer service. And it's kind of, this is your phrase of reinvesting in the business. They have a wider variety of inventory, and it's going well, so they buy a bigger place, and so they put a down payment on a bigger place, and it's a bigger store, again, continually attracting customers, providing great prices, great service, really good return policy, and this bigger store, they hire more employees. They continue to only take their $200,000 salary, and they pay income taxes on that $200,000 salary. But as this business grows and generates more revenue, they buy a second location. And so decade down the road, they have only earned $200,000 or plus inflation. But if there's a enterprise value of the business, you have 2 stores generating, let's say, 10 million a year in revenue. So it's like 20 million in revenue. So there's probably a business is probably worth, what's a good multiplier of like profits or revenue versus kind of discounted cash flow of an enterprise value of a business.
You can
Let's
do a
say
10x.
Okay, I was going to say just a few X, but because it's not like, it's hard to say it's profitable because it keeps reinvesting back in. But okay, so let's say these 2 stores are worth $20 million. Okay, so if he wanted to cash out, if he hires a new CEO or hires a new kind of general manager to run each store and someone else to run the business, like, you can replace that at a skill level, but now he or she is worth $20 million. But if you're trying to tax that, like, he doesn't have the money to pay a wealth tax because the assets of that are kind of the land of the buildings that they own, the inventory, which has to be sold out, and a lot of the revenue goes, I'd say the majority of the revenue goes to employees. at this point. Or maybe they kind of employees plus buying more inventory. But it's successful, it kind of keeps building up more stores, but it's always like only takes that $200,000. Every other chance is trying to hire more people. Again, kind of really high employee to customer ratio, really good prices, and now has a net worth of $100 million based on 10 stores. Kind of keeps, again, like I said, reinvesting back in the business. So the kind of thought exercise is, how would some kind of like wealth tax be assessed? Because this individual hasn't really benefited from the value of that business yet. But when he gets to be 60, wants to retire, sells the business, pays a big capital gains tax. Like when he has the liquidity event, that's when he pays the taxes. And so he pays a really big capital gains bill, not as big as a income tax rate, but still, it's gonna, if he sells the business for $100 million, he'll pay, if it's in California, between federal income taxes will be, federal long-term capital gains would be 23.8% now at the current level, and then add in the state of California another probably 13%. So they're paying what did it say, 37% in long-term capital gains taxes. So that's still netting $63 million, but like that's when the liquidity happened. That's when he actually was able to realize the value of the business that he had built up. And at every point along the way, every single year, there wasn't excess money or even excess ability to sell part of that wealth, even 1%, because all of the revenue was accounted for and all the assets that made up the business were kind of illiquid. So one, like you can see, this is kind of the theory behind why there's capital gains taxes separate from income taxes. But two, this is also like, this was the Walmart story, kind of, and a little bit kind of some of the Amazon story, where there wasn't any of those profits for a long time. So even the corporation didn't pay income taxes. But you can see how the wealth growth occurred and why it's considered illiquid. And so kind of given that thought exercise, if you're thinking about Walmart or Amazon, part of it is that at what point should that wealth tax or that wealth be, I don't want to say penalized, but like trying to get to one of these solutions of the ProPublica's true tax rate, and a little bit like, how would you do it? Because this is part of what happens for a lot of these wealthy individuals, is that the wealth is kind of illiquid until it's a publicly traded company. And now, sure, if it's a publicly traded company, then they have the ability to sell those fractional parts of their estate, of the net worth. But they have to actually sell and give up ownership of the business a little bit at a time. And they're selling off a percent per year if they were trying to pay us some kind of wealth tax. But that's also because they're a publicly traded company, the economy has done well, and the growth of these companies is more due to the stock price increase over the last decade. And that was almost like something beyond their control. They've benefited, but I think they've benefited in similar either percentages or rates or pro rata as anyone else who has benefited from stock price growth over the last decade. There have been a lot of people who have seen their liquid net worth double or triple in the last decade. and so like that's a small part. Like one is it like the timing is the timing of the ProPublica article looking at the tax rates while we've had this really impressive stock market growth, and that's a slightly different conversation of like the stock market and who's actually able to buy and participate in this growth of the stock market versus the economy, and that's tangential. Maybe we'll have to go down that path of, again, wealth owners versus income earners. But given my example of what started off as a small business, grew into a medium business, and started growing into a bigger business, like where's that inflection point? When does it become, oh, your wealth was growing so much that it's now unfair?
Right. Yeah. I think usually before I try to dig into specific solutions, I definitely like to set the premise that it's not easy coming up with a tax solution that's going to sound fair to everybody and be easy to do. We've tried to pull it off with income. That's what the main impetus of our current tax system is based around. And it's not easy at all. What is income? Is that gift that goes from you to the other person income? Is that income that you earned that, was at a discount because you charged less? Well, is that discount income? Is that lottery winnings income? Is that money that went to XY corporation but went back to Z corporation? Then I happen to own both corporations' income. It's complicated. And we've had to come up with all of these, kind of gotcha type of things to try to get it all set and straight. And we've literally created thousands and thousands of pages of tax code to get it all kind of lined up correctly, maybe. But at the end of the day, what do we kind of see? We've seen from another one of our podcasts, I think this was on like looking at state taxes, that the tax system still ended up having a lot of regressive concerns, meaning that the poor ended up paying a higher share of their income in taxes when you account for all the little taxes involved that people have to pay. Now, what has that kind of led to? It's led to, there's this notion that we've seen income inequality get worse over the past generation. And we've seen this kind of accelerate as things have gone over time, even with all of these different things in place. And what we're kind of seeing now is the highlighted notion that wealth has also been getting more and more concentrated, and wealth inequality, along with income inequality, kind of in sidestep, kind of not, but right next to each other. What we've kind of seen is that wealth inequality has also grown, not in the near recent history, but also in the past 45 years. And it's just kind of getting worse and worse. And the question is, okay, what can we do about it? Can we design a system that's designed to kind of combat these things that'll be fair to everybody and take care of some of these concerns? Or do we kind of throw our hands up in the air? And do we also kind of say, well, there's going to be some complicated edge cases that it might be tough. The big one is, unrealized illiquid gains. What do you do about that? Well, I think it's one of those things of, if there's a will, there's a way. This isn't one of those things that computationally are impossible to achieve, I'd say. Right? There are certain problems that we realize now that humans will never figure out because it's just mathematically impossible for any entity to figure it out. But this, I don't think, is one of them. And it'll certainly be complicated, but I think there's a solution. But what I just said is, where there's a will, there's a way. Is there a will to realize that wealth inequality is an issue and we should probably do something about it? Or is it something that maybe it's too hard and maybe we should just kind of let it go? Maybe it'll fix itself. And I get the feeling this is one of those things that, it's probably not going to fix itself. I don't think eventually we'll get to a point where somehow the rich just say, you know what, I've had enough. Let me just, start paying more to the IRS. But here's how we can kind of think about potential solutions to get a little more specific. What we're really talking about, for example, with ProPublica, is the 25 richest Americans. To put this into perspective, when we talk about the top 1%, we're talking 11 million and above. The top 0.1%, we're talking 44 million and above. The 0.01, obviously you can keep tacking on zeros here, but at some point we might need to worry less about the wealthy's liquidity concerns. That if we target a demographic that includes 25 people, for example. So yeah, that there's a concern if, for that mom and pop example, if you're in, the tens of millions. But let's say, you start with just the top 0.0001%, that's approaching the top 25 households. Well, at that point, I'm hoping liquidity wouldn't be that big of a concern. These are, like you said, public companies at this point. And, if a sale has to happen below market value, I don't know. Is that the worst fate to society? I feel like there might be some flexibility there.
So I like that idea of where there's a will, there's a way. Like that's definitely a huge factor because that gets into the lobbying, that gets into like why is the tax code the way it is. But I also kind of just like that, like if there's a will and there's a way, like what are some of those ways? And so like as you're talking like them figuring out some liquidity, actually one of my thoughts based on your comments was, what if we got rid of all of the deductibility of business expenses? So if taxes were based on revenue, maybe we make kind of employee salaries deductible still, but so like if you have the taxes paid first, then the corporate income taxes, if they're on the same level as or at least closer to individual income tax rates, then that might be a way to kind of extract some of the wealth inequality generation as it's happening each year. So like it's still kind of considered an income tax, but instead of getting a deduction on the money that's reinvested in business by buying more inventory, leasing another space, maybe even hiring more employees, that could be an example of a way to address this. And it's just kind of one potential, I don't want to say creative solution, but it's like at least one idea that if we acknowledge that there's a problem, at least there's something we can do about it. We don't have to, like you said, throw our hands up in the air and give up.
Yeah, I mean, if we have our magic wand, I think what I might say is actually keep the deductions for the business, but extend them for everybody. Meaning, even a household, you don't pay taxes until you get to your bottom line. You've covered all your expenses, just like a business. And you can reinvest in your future like a business without paying tax. And if you have money left over that's growing your wealth, then yeah, that leftover sum, you can pay a tax. That would kind of equalize that concern. And then, what I might say, yeah, and because why shouldn't we be investing ourselves like a business? Why shouldn't we be forward thinking in how we set up our own household operations? And why should the businesses get to deduct all that and then outpace everybody else? Corporations are people after all. So, yeah, I'd say that'd be thing one. And then thing two is maybe we could throw in a wealth tax in there as you start accumulating wealth. But at this point, you're not taxing income on anybody. So maybe nobody can, say that they don't have the opportunity to grow as anybody else. But maybe we do tax wealth above a certain level. I'm going to make something up. Maybe above, let's say, $10 billion. Now, let's start with something like that. And then, what amount of wealth do you need to tax above 10 million so that you can pay for everything else? I don't know. We can maybe run a few back of the napkin numbers, but.
So one of the ideas I was thinking, like, again, I kind of like the arbitrary $10 billion number. I was even thinking a billion, but just because it has a B instead of an M. But I was also thinking, like, well, what if it was publicly traded companies that, like, I don't even know how you do this, but like either tax the company like 1% of the growth of the company or something like that, or so it affects all shareholders, or do you tax just the individuals where they have to sell 1% of their holding each year, uh, or they have like just 1% of the gross, like publicly traded companies, like there's enough data that I think we could actually do this pretty well. But then, like everything else related to tax, I think they would change the incentives. I think we'd see fewer companies go public and more companies stay private, which might actually concentrate the wealth even more, or make it harder for other people to participate in the growth. Like I wasn't quite sure that that would be the solution, but I think there was something like that.
Right. Yeah, I think, if it's something where we start with a really high number and any number above that, I think if you have $1 billion, figure it out, right? So,
Yeah,
and here's why I say that. There's already a wealth tax out there. It's called the estate tax, right? And when you
yeah,
pass away, you have to pay a wealth tax on your estate. And you have to figure out all the values of everything you own. If it's above a certain amount, here it's like 22 million if it's a household. Well, anything above that, you got to pay 40%. Now, to do that, you might have illiquid assets, Crimea River, I don't know. But here's what the wealthy do. They plan for it. They come up with provisions to have liquidity when they need it. There's ways and products and financial market solutions to do it. I'm sure Wall Street will figure out ways to help with that problem. And the various things that the wealthy could potentially do is they can set up vehicles to create liquidity in the event that they need it. And I think there's solutions like that here that will likely come into play if this was a thing. And it's one of those things where you even touched on this point. After $1 billion, did the wealthy do anything spectacular to go from 1 billion to 2 billion, or did they earn the market return?
yeah. It does feel like vast majority of the time they're it's it's not truly market return because it tends to be so concentrated, but it is like Jeff Bezos, Amazon outperformed the market, and so that's where his growth came from. And while uh, Warren Buffett with Berkshire Hathaway, because that's a much more diversified company, like maybe that's closer to market return, but it is market forces outside of their control related to their individual company. So there's still a concentration aspect, but it is publicly traded stock that's driving his net worth growth. Bezos and Elon Musk. I don't even know if Michael Bloomberg is that a publicly traded company?
Bloomberg, no. It's one of the largest private, I believe.
Okay. So that actually be like that because he's one of the four examples that we have the picture of that would be interesting. His net worth growth was mostly private, whereas Bezos, Buffett, and Musk are public.
Well, okay, so there was some data that I've looked at the past about, how did the richest X demographic do? And it's interesting to note that for example, the top 400 Forbes, and this is on a year by year basis, but the data I have is from 2017 to 2020. Each year, on average, they didn't do better than the S&P.
Well, yeah, that's on average.
So there'll be some that do better, some that do worse, but yeah. And you picked out a few, like Amazon did better and X didn't do, and so on did work. But on average, the 400 richest families, they didn't outperform the market. They gave up the same 1 or 2% the average household did.
Correct. But again, because you're averaging 400 households, like 400 households might own 400 companies of the S&P 500.
That's true. Yeah,
almost by definition, getting the average.
It is.
They make the average.
This kind of begs the question, though. That again, maybe an earlier point was, but we want to let these people do money, have it, have the wealth to make the decisions to do better. But are they going to do better or about the same?
That's the point. It's like, do we think Bezos is better than the average 10 billionaire?
And look, he might be. He very well might be. But here's the opportunity cost. About, you take the top 3 richest people, and that's equal to the wealth of probably the bottom 50% of the country. So, yeah, we can empower the top 3 richest people, or we can empower 100 million people.
Yeah, I wasn't necessarily thinking in terms of like empowering like the top 3. It was more
not clipping the wings.
Yeah, it's the top 400 are getting the market return. Like the average of those households are getting market return. So like it does not necessarily imply that there's any outsized skill just because they got to that top 400, but each of those individual households is still concentrated, and so I don't think we're disagreeing here. It's just a like how we measure net worth growth kind of thing. So yeah, they're getting the market growth of their individual company, of their individually publicly traded company, something like that.
Yeah, but so the high level point though is the concern about taxing wealth is, yeah, it's hard to do, and 2 is, do we want to stymie these individuals from growing the economy more? And I'd say the other side of that argument is, well, we're also leading to a point where wealth inequality is hitting this kind of runaway. It's like a runaway greenhouse gas concern, and do we want to turn into Venus type of thing?
Yeah, so yeah, I think that's probably, it goes back to your phrase, like if there's a will, there's a way. Like if we wanted to do it, we can figure it out. We can pick some super high number that only affects the 25 wealthiest, like something like that. But it'll be so high. Like you can figure out how to tax these estates over 10 billion. Just out of curiosity, what was the number for the 400? Do you happen to know that?
In terms of the wealth?
Yeah.
No, I don't have that.
Do you know, like, do you know if were they all over 10 billion or were they all over 1 billion?
Well, it's the Forbes richest whatever, so maybe a quick 400. There you go. Let's see here. So
go down to,
I gotta go to the bottom of this list.
2.1 billion.
Okay, there you go.
Okay. So yeah, so if you picked 10 billion according to Forbes, let's see, scrolling on the internet is great podcasting. It actually only affects 50 households.
Okay.
That's like a interestingly round number. 10 billion is 50 households.
Right.
Okay. And this is interesting. Number 49, Hank and Doug Meijer. Their net worth is from supermarkets. So I was like, there's my thought experiment, my little example.
Yeah, sorry, Hank. I guess you gotta figure it out. You might have to hire somebody to do some financial math.
Okay. Well, it's yeah. I think that's a great phrase. Where there's will is way. So and maybe that's the real benefit of the ProPublica article is not necessarily trying to provide solutions per se. It's just creating public awareness of the problem. If we can create enough incentive for lawmakers and policymakers to help the bottom 50% or the bottom 99%, then maybe that will overcome some of the lobbying efforts by the top 1%.
Yeah, and I think that there's a lot of different concerns that somebody might zero in on when it comes to taxes, but I think this highlights what I think is one of the larger ones. And frankly, at the end of the day, that there's been a lot of chat, like I said at the beginning of this episode, that should the highest tax rate be 37%, 39%? It's not going to make any difference to what we're seeing here. You can make it 100%, doesn't matter. That this acceleration in wealth will happen no matter how high the marginal tax rate is.
That's a really interesting. I first thought, no, you can't make it 100%. But then I go back to the article. I think the highest number of their four, Michael Bloomberg had 10 billion of income, but 22.5 billion of wealth growth. So even 100% marginal tax rate would be a 50% wealth growth for him.
Yeah.
But for Warren Buffett, his wealth grew 24 billion, paid 125 million in income. Yeah, if you charge 125 million dollars in taxes on him, that's still only a fraction of his overall wealth growth.
Yeah. So, at the end of the day, income taxes don't matter in this conversation at all. It won't make a big difference to the wealthy, however much you tax income, because at the end of the day, if you have appreciated wealth that's unrealized, it's taxed at zero. That's just how it works.
Yeah. Well, I think if it was my idea of businesses no longer get deductions, something like that, that might be a way to do it as an income tax, but still, no, because it's still well, I don't know. Would Amazon stock go up if the profitability was cut dramatically?
See, the tricky part with taxing revenue is every business is going to say, but wait, I have a far higher built-in expense, number than another business. My business is capital intensive. I need to have expenses. My margins are 2%. Why am I paying?
Oh,
and
that's a good point.
Right. So that's always going to be a tricky conversation to have. And there will be ways to
not all businesses have inventory and need need space for customers to come in.
Yeah. So I think that might be a harder conversation to win.
Yeah, because I think a lot of service-based businesses will have much higher profit margins.
Yeah, and there's ways to, what is revenue in air quotes, right? Is it something that somebody pays to you initially, or are they going to pay something, but they have to pay for your electric bill first, and then you know what I mean? Yeah. So that it opens up a whole new can of worms. I think it might. But Aaron, would it be great not to have to worry about income taxes until, you're 10 years from now when you have $1 billion? 10 billion?
Yeah. I paid it on my salary, the $200K per year for the next 10 years. I paid my fair share.
Yeah, but I'm saying with my new proposal.
Oh, that I get to deduct everything?
Yeah, no income taxes until your wealth grows above 10 billion, then you pay your wealth tax.
Yeah, I don't mind deducting my trip to Disneyland.
Yeah, it's a business expense after all.
It's the personal version of the corporate retreat.
Right.
It's necessary for mental health and well-being.
It kind of is.
Now that you're in Florida, are you going to Disneyland more or Disney World?
It's on the list.
Okay. Well, this is a fun conversation. Thank you for entertaining my thought exercise.
Thanks, Aaron. I enjoyed it as well, and thanks everybody for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and has no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.